All right, let's talk Luminar. We're digging into their Q3 earnings call today, and wow, this one's a textbook case. It's a perfect example of how a headline earnings beat can hide a much, much deeper story. And that story is all about survival and a massive restructuring.
So here's the puzzle, right? Luminar drops its earnings report, and on the surface, it looks pretty good. The stock even jumps up in after-hours trading. But then, fast forward to the next day, and it's suddenly in the red. So what happened? What on earth did the market see that made it do a complete 180? That's exactly what we're going to unpack here.
Okay, first up, let's look at the headline beat. This is what got everyone excited, at least for a little while. The surface-level performance was actually pretty surprising.
And the numbers don't lie. Look at the surprise factor here. It's pretty significant. On the bottom line, their earnings per share came in at negative 94 cents. Now that sounds bad, but the street was expecting negative $1.05, so they actually beat that by over 10%. And on the top line, revenue hit $18.7 million, just edging out the $18.4 million consensus. So, check and check. It was a clear beat on both of the big metrics.
And listen, this wasn't just them beating against some super low bar. We're talking 21% year-over-year revenue growth. For a company that has been under so much pressure, seeing that kind of growth on the top line, yeah, that's going to turn some heads. It's a real attention grabber.
So, where did that revenue come from? Well, it was fueled by actual real-world output. They pushed about 5,400 LiDAR units out the door in Q3. That's a nice little jump from the 4,800 they shipped in the second quarter. So the factory's running, the product's moving, everything looks pretty good. So far, so good, right?
Well, this is where the story takes a very, very sharp turn. Because once you look past those shiny headline numbers, the earnings call revealed something else entirely. A massive, painful, and probably necessary pivot for the entire company.
The new CEO, Paul Ricci, really didn't pull any punches. He pretty much framed the whole call around this idea of confronting difficult realities. And let me tell you, when a CEO starts talking like that, you better listen up. It's a huge signal that those positive numbers you just saw, they're just one tiny piece of a much, much messier puzzle. The real story here wasn't about growth, it was about pure survival.
And here they are, those difficult realities in black and white. First, a crushing debt load of almost $430 million. Next, they are absolutely hemorrhaging cash. We're talking negative $48.5 million in free cash flow in just one quarter. To stop the bleeding, they're laying off about a quarter of their entire workforce. And then, the big one. They've suspended all financial guidance. That's basically them saying, we have no idea what's going to happen. And the final nail? They're officially putting themselves up for sale. This isn't just a tough quarter. This is a company in full-blown crisis mode.
So how are they even dealing with that mountain of debt? Well, they've entered into something called a forbearance agreement. The easiest way to think about this is like a temporary ceasefire with their lenders. It's the bank saying, okay, we won't call in all your loans right now. But, and this is a huge but, it's only for a very short time. Luminar's first deal only lasted until November 24th. They're hoping for extensions for sure, but this puts them on an insanely tight deadline to figure something out, permanently. The clock is ticking loud.
Okay, so now that we have all that, pretty scary, context, let's go back and look at how the market reacted. The stock's movement tells the whole story, a real pop-and-fade narrative. You can literally see the market's brain working in two steps here. The stock closes at $1.06. Then, boom, the headline beat comes out and it shoots up 14% after hours. That's the knee-jerk reaction to good news and the hint of a buyout. But then, as people actually read the fine print and digested the details on the debt and the cash burn, all that optimism just vanished. It evaporated. And by the time the market closed the next day, the stock was actually down almost 5%, a total reversal.
So what we have here are two completely different stories being told at the same time. On one side, you have management. They're trying to spin this tale about a long-term strategic plan, this pivot to a new business, and all the optionality from a potential sale. But the market heard something totally different. It didn't hear restructuring, it heard liquidity risk. It didn't hear pivot, it heard massive debt. And it didn't hear M&A optionality, it heard shareholder dilution, and frankly, the very real possibility of insolvency. They were speaking different languages.
So, where does all this leave us? What's the bottom line for investors? Well, looking ahead, there are a few absolutely critical things to watch. And this brings us to our final take, our thesis on the path forward.
Look, Luminar's future is no longer about small revenue beats or how many units they ship. Forget all that. From here on out, it's all about these major catalysts. Number one, and this is the big one, what happens with those forbearance agreements? Do they get extended or not? Number two, does anyone actually show up with a real binding offer to buy the company or its best parts? And number three, can they find someone, anyone, to give them new financing to keep the lights on? These are the make-or-break events that will decide everything for the stock.
So putting it all together, a rating here is underperform. The thesis is actually pretty straightforward. Yes, there's a lottery ticket, a little bit of option value that they get bought out, but that tiny bit of hope is just completely dwarfed by the much more likely scenarios. Either a financing deal that crushes existing shareholders through dilution, or, worse, insolvency. At this point, for anyone holding the stock, the risks just massively outweigh the potential rewards.
And of course, just a reminder, this is not financial advice.